euro, pound, gold, all other asset classes are free to move higher because it's risk on. And we saw a huge risk on event this past week where most asset classes went up while the dollar crashed. Over here on the hourly chart, I want you to notice this little shaded area here. That's the propulsion block. That's this whole range here, but visible on a hourly chart. So we have relative equal lows here. We drop down into it. We trade above this short-term high right there. That's all it needs to do. That's a shift in market structure. It doesn't need to close above it. It just now sets the thing in motion that we're going higher. Doesn't mean you can't have retracements, but look where it retraces. If you take this propulsion block right here and you divide it in half, that's mean threshold. That's what this drop was going to right there. It's going right there, and it's also cleaning up these smooth edges in the bodies. Wait a minute, that's not smooth edges, ICT. Look at this wick right here, or this tail, and look at this right here. Look at the bodies. The bodies tell you the story. That's the narrative. The wicks do all the damage. That's the stuff that everybody gets hurt by. You get stopped out and you don't want to go back into the marketplace. That's their purpose. Reading price action with a time-based chart and focusing on the bodies of the candles. If you just saw these right here like this and there was no wicks or tails on your candlesticks, if you took that completely off your chart, this would look like smooth edges. And that's all this was, trading down into mean threshold, which is the entire range from high to low. Split that in half. That's this level right here. That's occurring right in this level, digging into it after we had a shift in market structure. So what am I saying here? At this point, right there, that's slightly higher high than this one, because we've had sell side taken there. Now we have buy side. We're bullish. So we have now met the minimum criteria for high probability directional bias. So now we can absolutely predict higher prices. We can trust that higher prices are likely to go where? Up in here, this mitigation block. So if we're looking for a 15,693 level, and we're down here and we drop down to mean threshold, at that point, does the market want to rally away from it? Sure looks like it does to me. Tries one more time, digs into it, but look where the bodies are showing. They're showing it's respecting that propulsion block right there. We've already did the damage of going down into it, and here bodies are supporting the high end of the propulsion block, that shaded area. And then we want to see, does the market want to rally? Well, here's the thing. If you're looking at depth of market, or if you're looking at footprint, you're going to start seeing all the things that would justify the market wanting to go higher. We already knew that. We already knew all those things. And from here, as soon as we get these candlesticks showing this, and this candlestick closes, the next candle here, and it drops down and touches this high of this blue shaded area, which is this candle, that range on the daily chart. We're working with the hourly chart here now. I know that we're likely to go higher. Where? We have all this sell side imbalance, buy side inefficiency. So basically this candlestick's low. And then we have the buy side above this high here. There's buy stops resting above that. But this also is another pattern. It's a breaker. So I know that everyone that uses a depth of market, uses a footprint, they're going to be looking for justifications to go higher or lower. The folks that would be looking at it with the expectation that the market's going to go higher, the evidence that they're seeking will be there. Every instance of it would be reflected in those tools. I don't need to see that. I already know that the market's going to go towards these levels. It's driven that way, not because of buying and selling pressure. I have already arrived at these ideas before the markets even opened up, before the market even printed its first book on Sunday's opening. We had already codified the expectation that these markets were going to go higher. And to where? There was no need, there was no way for me to look at depth of market or a footprint to justify those things because the market hadn't already done anything yet. So while the markets were static, using experience, using institutional order flow, reading the tea leaves, okay? Reading price action. So for the folks out there to say, if you're reading the tape, so this is reading the tape, folks. You're watching price and how it gyrates off of my PD arrays. That's reading the tape. When someone says, show me your order book, show me your order book, that's the stuff at the beginning of this video that I don't need. Before your order book, before your depth of market, before your ladder and your footprint tools start telling you anything, I'm light years ahead. The footprint, that's something that is happened. This is where the buyers were. This is how many orders were bought and sold at these specific levels. Okay, that's wonderful. That's wonderful history. I loved it when I was in school. But who has a better perspective, folks? Okay, someone that's ahead of you on the path that you're walking right now. Someone that is a quarter mile up the road. They've already walked this path multiple times, many times. They know the terrain. They know where the sticks are out and the thorns are. And who has the better perspective? You, as an inexperienced student of the marketplace. Someone that's new. Maybe you started in 2015. You're looking back and wondering, can you trust these tools? When I'm ahead of you in experience and I can read these charts without any of that stuff, and I know where you're going to see new buying entries, and you're going to see retracements to take out liquidity. You're going to see inefficiencies and how they're going to use those inefficiencies. And I've proven this numerous times with live executions. I've called the market minute by minute live on a live stream, not pre-recorded. You have all sat there and watched me do this. That is reading the tape. I don't need these gimmicks to talk about what's happened already. I don't need to see that order book. I'm going to tell you where the market's going to go before the order books talk about it. That's what my students are able to do. You may not have that skill set yet. You will over time. It doesn't happen overnight. It doesn't happen real quick. But you still are left with the puzzle of where is price going to go, higher or lower? And in between where we are at market price, how will it behave? Well, let's talk about that. If this is the propulsion block, and we've already seen it dig down into here, but if we're expecting price to go up to this blue line, and we're seeing evidence that all these things down here, stops have been taken, it's swept, we have all these bodies here, which is relative equal lows. Forget the wicks, go back into the bodies. They're telling you the narrative. That's the storyline. That means they're going to want to sweep through it. There you go. It's happening right there. So when this is a full bearish candle, I would be buying that. You probably wouldn't. Most people on YouTube, Twitter, and Instagram, and Discord, and things like that wouldn't buy that. They would be too afraid. They had no idea price would react that way. But I'm leaning on this being a propulsion block. This is an order block that's already confirmed that it is. We broke through this candle's close right here, which is a rejection block. It's showing a willingness to want to go higher. I don't need this high to be taken out. It's went above this one here while I'm bullish. This down close candle is a propulsion block. So that range I'm shaded here, I'm putting that and transposing that onto an hourly chart. So I'm watching price action on an hourly basis, how it performs. See, you would not have the context of using everything I'm talking about here without having the daily chart, without having the weekly chart, the draw on liquidity, this blue line here. So when I'm looking at price, whether I have it on the chart or if it's on my notepad, because I'm using a notepad, unless I draw it out on the chart for you because you're going to watch the video later on, there's no annotations on my chart because I want my focus on where we are in that range. So on my notepad, I have the high, the low, and the mean threshold price point of that candlestick right there on the daily chart. And I have on my notepad daily propulsion block, high, mean threshold, low. So I'm watching price when it's meandering around in here. I'm watching time of day and how it responds at those specific levels because I'm predicting, I'm anticipating, I am not reacting to anything. The only time that I react is if I'm wrong and I see the evidence in price action that I'm offside or am likely to become offside. Then I'm going to react to that new information and say, okay, I got to bail on the trade. That's the only permission that you're ever going to get from me to react to price. Because everything else, we are absolutely predicting price. You are doing that. You're predicting the future. That's what this is. It's future. It's why they call it futures trading. It's in the name. And why are you arguing saying you're not trying to predict the price, or you shouldn't be trying to predict the price? You are. If you are bullish, that means you are predicting higher prices. If you're bearish, you're expecting and predicting lower prices. How are you reacting to anything? If you're reacting, it means you're chasing price. I'm not chasing price. I'm waiting for very specific things where price will walk into my crosshairs, and when it does, it's going down. I'm going to pull the trigger, and I'm getting my entry. I have 81 ways to get in there. Trust me, I'm getting in there. If trading was like a cat burglar, I'd be the best one at it because I can get in that bitch. So we have the mean threshold here, rallies back above, relative equal highs have been cleared here, and now the bodies are showing that there is an interest in seeing no further decline. Well, how do I know that? Because the bodies are not closing inside that blue shaded area. It's already done the work of doing what? Trading down into mean threshold. One more time, shifting higher. So market structure is now, again, one more time, bullish. So where's their inefficiency above this price point right here? When this candle closes, this one right here, when it closes, where is the draw on liquidity from that price point there? Well, you have this short-term high. So do you need a depth of market ladder to tell you, or book map, or some kind of order flow application to tell you there's going to be buy order stacking above this high here? Do you need that? Because I don't. You don't need that. That's reading the tape. Do you need to know that all throughout this decline here, while price starts going up, you're going to see all the orders above the marketplace being eaten into? Because that's expected. We expect that. We anticipate that. We're not reacting to that. We're not surprised and saying, wow, look at how the depth of market ladder is showing how all the orders just keep getting eaten and consumed. That's expected. That's reasonable. We expect that. We're not surprised by that. We're not surprised we don't care what the number is either. I don't care what the footprint's saying, how many people bought this level and versus that. I don't care, because my focus is on it's going to roll right back up this inefficiency, which is a SIBI, sell side imbalance, buy side inefficiency. It's a classification of a fair value gap. But then once it goes to this level here, it's not done, in my opinion, because my focus is up here. So I'm reading the tape. I'm watching how it delivers all through here. Once it gets to this price point here, I'm going to anticipate. I'm going to predict. This is where I would be in my live stream. This is where I would be in my recording of my execution. I'd be typing out big range candles incoming. When it gets right here, right to that price point low, right there, I would be typing out, we're going to anticipate, we're going to expect, we're predicting, we're not going to be surprised by large up close candles. Why? Because it's going to make a quick run for the liquidity resting above this high. That's what the algorithm does, folks. That's what it does. You don't have to do it. But everything I'm telling you happens. I'm telling you what goes on in the marketplace and why it does. I'm literally teaching it to you. I'm not demonstrating toys. I'm teaching you how to do it. What you have to do to develop this skill set. It takes work. It's not watching a video. It's understanding what you're supposed to do and then go out and do it yourself. And it's going to feel like you don't know what you're doing in the beginning. But showing up every day in front of the charts, reading the tape, that means studying how it behaves without putting a demo trade on, without putting a live trade on, without trying to pass a combine on a funded account. It means simply studying what price does based on the time of day and day of the week. Knowing in advance, which I tell you where the market's going to go. It's going to go up or it's going to go down to a very specific level, not range, not zone. And you use that 30 years experience to trust while you're studying.